Hello. It's like 4 in the morning and I can't sleep, so I figured I would just make you a video explaining how I invest, cuz I just enjoy it and I'm sitting in bed and I just can't sleep. So I'm going to kind of I don't know how long this video is going to be. It could be like 20 minutes, it could be an hour. But this is pretty much a simplistic way of how I invest, and I'm not scripted or anything. This is mainly a video I might send to like my family or just friends or whatever, anyone who needs help investing. At least, I've only been doing this for like 6 months, so there's obviously going to be like room for improvements and maybe mild changes. But I don't see this strategy changing much. The only thing I would see changing would be the type of stocks I pick or which ones I don't want to hold anymore, etc. That's all there is to change in an investing strategy, I suppose. So before I get into this, I'm gonna have a list of all the books I've read to help me get this this pretty much gained. What am I trying to say? This pretty much gave me this investing strategy. Pretty much, the main book that's I'm gonna be taking from today is what's it called? Let me see. I've learned more from this book, and it was kind of like after I read it or listened to it on Audible, it was like, damn, I got to change my whole portfolio. It kind of made me feel bad at first, but it's actually just amazing. It's called Getting Rich with Dividends by Marc Lichtenfeld. Excellent book, really good. It has something called the 10, 11, 12 step, which is actually a really simplified way to invest. Now, if you don't know anything about the stock market at all, this is still like a video I think you could watch, because I'm going to try to go over like the basics, starting with what is a stock, what is a share, whatever. Now, disclaimer, this is a video on investing, not trading. So I'm not interested in buying a stock and then waiting, like a week or a month and then selling it. I'm going in, my investing strategy mindset is to buy these shares and never sell them. You're gonna see my tip in this, in what I've learned so far. Like I said, there's gonna be a lot of differing opinions on the stock market and how people want to invest. My thing is that, like I said, my mindset going into this is to buy and never sell these shares. And you're gonna be like, how do you turn a profit if you never sell? So I'm gonna explain to you how you make a profit by never selling these shares, and it's with dividend payments. So we'll go into that. There's gonna be only a couple reasons why you would sell your dividend shares. So before we do that, let's get into here. First thing we want to go over is, how do I pick my stocks? First thing you want to do before you can buy, you want to know what is a good stock to buy. So we're actually going to be using AT&T here today, which I actually think is a super good buy right now, in my opinion. And that's not me giving you financial advice to go buy it. I just think, in my opinion, I really like it right now. So first thing we're gonna go over is, what is a stock, I guess. So a stock, we'll just do this. A stock, in short term, is just a share or percentage of a company. You're lending a company money to legally own, as far as I can understand, legally own a share in that company. So it's like a really shortcut way to, own a part of a company or whatever, I guess. So let's break it down now. That's what a stock is. I think everyone knows that, maybe. So let's say this is a stock. Well, oh my god, you can't write on MS Paint at all. So we're just going to put S for stock. This is a stock. And we're going to use AT&T stock, for example. So the trade symbol is literally T, or the ticker, as people will call it. It's called ticker. And you can go into depth on that stuff, but we're just going to keep it simple today. The ticker's T. So I will break down a stock and if I like it or not into different sections. Now, we're going off stocks in this video, and maybe I'll also go in a little in depth into my portfolio. But right now, let's try to remain a little bit focused. So the first thing I always look at is always something called the dividend yield. So we're gonna put DY. So these are like the 4 healthy parts of a stock that you want to see. So the first one is a dividend yield. So in explaining what a dividend yield is, we're just gonna take the price of, I don't know exactly the math breakdown because I don't actually have to use it yet until like years later, but it's very easy to figure it out. So first off, dividend yield is a percentage that you're gonna get that you're gonna get paid for the stock based on the price. So right now the price of AT&T is $28.96. So if I can write 28.96 is how much it's worth right now. Excuse the terrible thing. And right now it is worth or it is paying out $2.08 annually. So this is yearly. So what a dividend payment is a company generally will pay you for holding their stock for each share you hold every quarter. So that's every 3 months. Some of them do it monthly, but not very many. So right now, quarterly, they're paying out 52 cents every quarter, or a 208 yearly. So we'll put a Y for yearly, 208 yearly. So what that brings it down to is a dividend yield of 7.18%. And there is a way you can actually calculate this yourself, but you won't if you have a brokerage app like Robinhood or even Fidelity, or even looking it up online. Like for example, if we go over here, you can literally see the dividend yield right here, but you want to make sure that you're looking it up either on like a website like MarketBeat or Robinhood or whatever investing thing you want to use, because it's like live. Because sometimes you can look up, like if I look up ITW stock dividend yield, which is it says like right now the dividend yield is 3%, which $1.07, 3% is okay. I mean, it's not terrible, but if you look on the live, like if you look at the live tracking of it, like on Robinhood or whatever app you want to use, the dividend yield for ITW is actually 1.9%, which is a lot worse than 3%, obviously. So they really take it and calculate it live based on the current price and what is expected to pay out, or maybe the last payout. So it is a percentage based on how much you pay for the stock and how much you're getting paid for the dividend yield. So this is like old or whatever. So just make sure you're getting the accurate prices or the accurate percentage on that, because you don't want to think you're buying a 7.18% dividend yield. So two things, or a couple things here. A healthy percent for a dividend yield is usually around 3 to 4%. A dividend yield this high is usually not a good sign, honestly. But I'll go into explain why that for in this case for AT&T that I feel like this is perfectly fine and actually really good opportunity to buy right now. So the next thing we're going to talk about here, we've already gone over the dividend yield, and we'll just put 2.08, so we know that's how much you're getting paid yearly for it, and that's the price of the stock. So the next thing we're going to go over is what type of stock this is, which is a dividend aristocrat. So what a dividend aristocrat is is it's an elite group of stocks. There's a thing called blue chip stocks, and what it means to be blue chip is that you're like elite. Like you don't have to be Dividend Aristocrat to be a blue chip stock. So something like Apple or Facebook, a highly successful company. I think it's something about a company has to grow so much every period to be a blue chip. I'm not quite sure on that one. So, but that's my guess. Anyways, a Dividend Aristocrat means that they not only have paid dividends for the last 25 years, they also have to raise them every year for the past 25 years. That means every year it's going up at least a penny. It just has to go up, and that's what we want to look for. We don't really care about I mean, it's okay to have a stock. Like there's some stocks that will just pay 1 year they'll pay 30 cents, next year they'll pay $1, the year after that they'll pay 10 cents. I mean, it's something, but usually for this strategy, I'm not interested in that. I want to invest in these companies that are continually raising their dividends every year, because that's a very healthy sign that it shows that the company is being ran by good managers that care about the shareholders. And it also holds the company accountable, because if they cut their dividend, and that's where we're going in here. If they cut their dividend, they know that the stock's going to fall. It's going to hurt them financially, and they have shareholders to appease, which shareholders are usually own a large portion of the company. So it's good that management will show them respect in increasing the dividend every year. So that's what I'm going to say is you want to watch your stocks, and you don't need to check them every day. You can if you like, as long as it's not making you lose sleep. That's a big tip for me. If you're losing sleep over your stock, you need to do something about it, in my opinion. But anyways, the reason you would sell your stock is if they cut the dividend. If your Dividend Aristocrat cuts the dividend, like makes it go down or totally cuts it, you sell it the next day. That's my advice. The whole reason I'm investing in these companies is for the dividend payments and the dividend reinvestments. So I'm really not interested at all if they cut it. So hold them to very high standards. I mean, that's your money. It's going into. It's important. So I feel like I would sell it definitely if they cut the dividends. Now, the only other reason I would sell is if you are making so much money off your stock that you're losing sleep over how much money you've made, which I don't know why that would happen with these. They're very slow growers, but that's a point that's been brought up to me, and I feel like I would sell it if it was like $1 million, or I don't know. Maybe not, because I know that I'd be making dividend payments or getting dividend payments anyway. So that's this Dividend Aristocrats. We have the dividend yield, then we have the Dividend Aristocrat, which means 25 years. And for this strategy, it doesn't have to be Dividend Aristocrats, which is the past 25 years. It can be Dividend Champions and Dividend Achievers, which I think fluctuates between 10 and 20 years. I don't know which exactly. Sorry. Right now, but those are other ones to look into if you're having a hard time finding ones with good dividend yields. Also, the 10, 11, 12 strategy that I read in that book says that you want to pick stocks with 4.7% dividend yield, which can be really hard to find sometimes. So for me, my rule is I usually just look for 4, or if I really like the company, I'll go for 3, because I like Coca-Cola because I'll see them around for a long time. I feel like they'll be around for a long time. So, and they have a dividend yield right now of like 3.1, but I like the company, so that's an example right there. Okay, so let's move on. The next thing we want to look at is something called the payout ratio. So what this is, I use MarketBeat to figure out the payout ratio. You can actually calculate it by earnings report or something, and complicated. I don't really look at earnings reports. You can if you want to, but you don't have to, because there's websites like these. So the payout ratio is how much in dividends the company is paying out of their earnings, like on the cash flow. So let's say a company let's dumb it down really large. Let's say a company makes $100 in a year, which obviously isn't realistic, but let's go with it for simplicity's sake. Let's say a company makes $100 and they made that $100. Then they have to choose where they want to do with that $100. So they could reinvest it in the company or yada yada. But this payout ratio is the percentage of that money, of the $100, the theoretical $100 that they are paying back to shareholders. So a healthy amount is 75% or lower. I'll usually go with anything 90% or below, but 75% or lower is healthy. And the thing is that a company can actually, I guess, have money in savings, and actually, you can have payout ratios of like 186%, which is actually what I think Coke's payout ratio is pretty bad for right now. Oh, okay, it's not terrible. If this is accurate. Oh, okay, I thought it was pretty bad. This is actually pretty good. But if a company is going through troubles, they can go up to 186%, and that's just not a good sign. Sometimes like really good companies can just have a bad year. So just make sure you're kind of watching how far back the payout ratio will go. That's just another sign to see if it's healthy. So right now we're gonna do AT&T's. So we may have been looking at the wrong one, but anyway, AT&T's payout ratio right now for the past 12 months is 58.26, which is like insanely good. Remember, the lower the better. Especially with this high of a dividend yield. I don't know how they're doing it, but numbers don't lie, right? This is awesome too. Also, it tells you how long they've been paying. This is just not how long they've been paying dividends, but also how long it's been growing. So that's awesome. Wow, this is actually a really good website. Like, I've just been using it pretty casually, just like Google searching and checking multiple websites, but this one's really good, like, because you can obviously like go to Dividend and blah blah blah. Anyways, let's move on here. So the payout ratio is really important. I like that percentage. That's really good. Like I said, I would buy a stock with 90% payout ratio, as long as it's not, but anyway, 75% or less is your target here. So yeah, there's what's the last one? Okay. This is a big one. We're gonna talk now about dividend growth. That's G. So dividend growth. Our target that we want to see is 10% growth per year. So that's really high. That I don't think most companies are doing that. So that's the target healthy goal for the 10, 11, 12. Which if you want to know more about this 10, 11, 12 thing, you can literally Google 12, 11 or 10, 11, 12 dividend strategy, or even put Marc Lichtenfeld's name when you search it. If you need to, and you can find information. It's pretty much exactly this. This is pretty much the 10, 11, 12 strategy that I find so interesting. It's like absolutely amazing. Now, finding a company with 10% dividend growth is important. But for me, obviously you want that 10% if you can find it. Let's see, I think we could use Market Beat to figure out the actual dividend growth. This is the payout ratio, dividend yield 7%, 3-year dividend growth. Okay, so this is how much it's grown in the past three years, I'm guessing, which is, it's good. It's not 10%, but I think any dividend growth consistently is good. It doesn't have to be 10%. I think 10% is pretty hard to find nowadays. Maybe I'm not looking in the right places. It is. I don't want to say it's hard to find stocks, but you do really have to look at you do really have to do a lot of looking and research, which is easy as a Google search or using Market Beat. That's the thing. If you want all these key things, you can find here. So let's take a look. So we have all we do is search it, and we click dividend. We can find our payout ratio here, our dividend yield here, our growth rate here, and that's 3 out of the 4 things that we want. Right. Yeah, well, we can find it all here, because you can also see if it's a dividend aristocrat if it says 25 or more years of consecutive dividend growth, and this one has 50 years. So this one may not be any joke here. I mean, I would probably feel good about owning some of these, even though the yield is 1.9%. So maybe not buying it right now would be that great. So that's pretty much the 10, 11, 12 thing. This is how I invest. Now, I want to touch more on this and how important it is that dividends keep growing. So we're going to touch more on literally dividend growth, because I think this is super undervalued. Like, you don't realize when we talk about compounding how important dividend growth is. So let me touch on that a little bit. Oh, I can't go back anymore. Let me do another. Okay, so when we talk about dividend growth, so let's keep using T-Mobile here. Not T-Mobile. I'm sorry. The ticker's T. AT&T. Similar companies. I'm sorry. Let's see here. So what we're looking at, dividend growth. It's one thing. You can find like really good ETFs, which let me explain what ETF is. So when we talk about a portfolio, which a portfolio for your investments is pretty much your diversity in your picks. So you don't want to pick, all the same stocks in the same area. So if we buy like 90% of our stocks are in what is it? Hold on, let me see. Let's say business or whatever, or I'm sorry, I'm drawing a blank here. Let's say it's in. Hold on, come on, man. Let's say that it is in consumer goods. Let's say 90% of it's consumer goods. We'll put consumer goods. And 90% of the stocks you own are in consumer goods. Let's ignore the ETF, by the way. And then consumer goods crashes, then that's 90% of your portfolio crashed. But with this strategy, like, I don't even know why I brought this up now, because if something crashes, it's a good time to buy. Like right now, AT&T is down 6%, which is a lot for a dividend aristocrat or a blue chip. It's not like it had to be 20% or more to be a bear market, but 6% is a lot, so I feel like that's a good time to buy. But anyways, let me tell you why you want your dividend or your stocks to go down. I'm sorry, I'm like jumping everywhere from ETF. We'll come back to the ETF, but first thing first, the dividend growth. You want it to consecutively raise every year, because when the stock itself goes down, it's a good time to buy more, because with a dividend aristocrat, it's almost guaranteed that the dividend payment will raise every year. So if the stock goes down, you're paying a cheaper price for your dividend payment, pretty much like the payment you're going to get, which increases the yield, the dividend yield that we talked about earlier. So it's good if it goes down, and that's why consecutive growth is so important, rather than a growth that's going everywhere for the dividend payment. So we want to see something like slow, because it's going to compound. And also, by the way, very important that you reinvest all your dividends. You don't have to if you don't want to, but that's how compounding works, and that's really the main strength of this strategy and how I invest. Alright, so now that we've explained that, I'm going to explain what an ETF is, because I also invest in ETFs. I put them in my portfolio for diversity, because in my opinion, I think, as far as I can tell, they're the best for diversification. Now, almost all the ETFs okay, well, before I do that, let me explain. An ETF is pretty much a basket of stocks is the easiest way to explain it. Let's say we have a little basket and all these stocks in here. It could have hundreds of stocks, it could have 500 stocks. But that means if one goes down, the other ones can hold it up, so that, like, let's say let's say it has 4 stocks in it. 2 of them go down and 2 of them go up, so you're staying at kind of like a balanced thing. So that helps you get diversification. And also, a lot of brokerage apps will tell you if, you know, like what sector you own your stocks in, to make sure, like, give you percentages. Like right now, I own a lot of my percentages in consumer goods, and I need to diversify a little bit more. But the way I invest, I don't think it's the biggest thing. I do plan to add more bonds into my, like, literally 2 bonds into my portfolio eventually. It's a work in progress. So I would suggest throwing a few ETFs in there, the ones you like. I like Noble because it adds all of and the ticker is NOBL. It adds, I believe, all of the current Dividend aristocrats into one ETF, all in the S&P 500. So you might be wondering, well, why even bother looking up stocks if we can just use the Noble? Which, I mean, if you want, for simplicity's sake, you could just invest in those ETFs. But I think I mean, like let's look at this, for example. Like, this is one of the stocks in the ETF, I believe, which has a dividend yield of 1.96%, which you can get the average yield for in Noble, which I think is a good ETF to have regardless. But I would suggest, you know, doing some research and doing this kind of investing. But if you just want to invest in the ETFs, you could literally only invest in the ETF stocks, and you would be fine. It's a really good strategy. It's a lot easier than looking up stuff, because you really just want to own as many shares as you can in a specific ETF or whatever. But that's getting a little off track here. I have like 5. So for the portfolio, I'll recommend this for me, for what I've learned. This is what I like. B is for bonds. I want 2 bonds. And then for my ETF in my portfolio, I like 5 to 7, and maybe if I find really good ones, maybe up to 10. And then for my individual stocks, I like 15. Oh, that's supposed to be 5. I like 15 to 20. And what I'm going for here is I'm going for a number of around 30 different things, because the sweet spot, in my belief, is 25 to 30 shares. Like, if I had all 20 plus 10 plus 2 bonds, I would get 32 stocks. Well, 32 in total of these holdings. But that's just how I like my portfolio. Now, I'm not going to go into depth in bonds, because honestly right now I don't hold any. But what I will say about bonds is that I'm just going to add maybe one in, like, I'm going to add one in a sector I haven't invested much in, and then one in a high yield sector of bonds. I don't know if that's the proper wording for that, but I won't go into too much into bonds, because I'm going to be honest, I don't know much about them. But I know they're good for diversification, so I will be adding some. I'm pretty sure what bonds are pretty much like, if I've done a little research on bonds, and they just pretty much, like, this is how they go for as far as their prices go. So they don't really go down much. They don't fluctuate much at all. So I don't even know if you'll be earning more than inflation on your bonds, but I don't know much about them, like I said. So I think that about does it about how I invest. A few tips before we go. I know this was all over the place, but it's kind of just me free talking about how I invest. And I'm up for anyone, giving advice. But a few things before we go here, a little bit of a disclaimer is that I know that I know the stock market, everyone has their different opinions, and you would not believe how many different opinions and how wide the stock market is. So I know there's going to be people out there that think this strategy I'm doing is a waste of time and ridiculous, and there's other people who are going to think this is the only way you should invest. It's just the kind of thing, or maybe they wouldn't think it's ridiculous or whatever. They probably just, some people want to trade. So disclaimer, this is not a trading strategy. This is an investing strategy. It's two different things. You can say trading's investing, but I don't want to say it's gambling, but I don't think it's gambling. It's just it's more of a headache and more paying attention than I'd like to do. So with this, let me say a couple things you want to check at least once a year. If you want to buy these stocks or whatever and do your research, I would at least take a one day every year. Like, say you want to do it the 1st of January, just open up your brokerage, see how your stocks are doing, see how they reinvested, and then also if they've cut their dividends, just sell them. Other than that, if you hear any bad news or about your stocks or anything, you have to realize these stocks have been around forever. Like AT&T has been increasing their dividends for 37 years. You just have to ignore all the bad news. And a big tip is when your stock goes down, that's when you buy more. So make sure you're saving money so that you can buy when the market goes down. So what I like to do is I cost average my stocks, which means what I do right now is I take all the stocks in my portfolio, which I know there's a different way to do this. Say this is my portfolio, this ugly blob. These are all the stocks. I will cost average them, so I buy $30 worth of stocks every week, and I divide this $30 by every stock. So let's say it's like $273 is what I'll buy every week, and that'll cost average it, and so that's $120 a month, or like $1,400 a year or something like that. Cost average. So I'm getting the average price of these shares at the end of the year by cost averaging them. But what I also do is I make sure I save money as well and put it in my brokerage account that's called paying yourself first. Let's say I have $1,000 or whatever, maybe you saved up $2,000. So when I see something like T-Mobile, or I'm sorry, I keep calling it T-Mobile, I mean AT&T, when I see it drop 6%, I can spend maybe $1,000 on shares because it's a good time to buy. So you can also use your brokerage to see your average cost. At least I use Robinhood. I know it's a little controversial or whatever, but we're not here to get political. And it will tell you your average cost per share. So that's a good thing to remember. Alright, well, I hope that helped anyone, and I'm going to actually leave a list of all the books that I've read that have helped me. So if you want to read those, you can, and if you guys have any advice for me, go ahead. I don't really want to share my if you guys want to know, I'll share my portfolio. The only thing I'm worried about my portfolio is percentages. Like, I should be probably putting less percent of my like I said, $30 a week or whatever. Probably be changing my percentages. Like, I'll put like 70% of this $30 into stocks and the other 30% into my ETFs, which now that I think of it, I think I will do that. I just got to figure out the numbers, or something like that, percentages differently, and maybe I'll change this to actually like 28 and then put 2% in bonds or something like that. But anyways, I really like the stock market. I think it's really fun and enjoyable, and like I said, I plan to hold these for the rest of my life unless they cut the dividend. So thank you guys for watching. If you're one of my family members, love you. Thank you for watching. I hope this helped anyone, and y'all have a good night. It is now 5 a.m. Thanks. Bye.